Good morning, good afternoon, or good evening, depending where you are on the planet. And welcome to the Monday, the 7th of August, Bull versus Bear webinar. Steve Miley on the call here for Trade Day. Welcome, everyone. So, good morning, all. Welcome. Good morning, Richard. Good morning, Scott. Joining us for the first time. Yes, there is audio. Hopefully, you can hear us, Scott. Yes, audio. Give me the heads up to make sure you're okay. And we'll be going through our usual regular run through in here, looking at the fundamental macroeconomic geopolitical events and factors that are influencing financial markets right here, right now. Yes, also looking at a very brief look. We're going to start to wind down on the earnings calendar now, as most of the earnings are behind us. All the big names have reported. You guys are pretty much trading the indices. You can't trade individual stocks with Trade Day. So the only reason I'm really focusing on the earnings is how they might impact onto the indices. And with most of the reporting behind us and most of the big names behind us, most of what's coming now is not going to impact onto the indices. So we're not so concerned. But I will just very briefly today, while we look at, remember, on Mondays, what I tend to do slightly differently to the rest of the daily webinars is talk about the shape of the week, what I like to call the shape of the week. So we're going to take a look at the not only what's coming up today, because obviously as day traders at trade day, you're looking at what's going on today, right? But however, we also, I think, is good practice to understand what is coming ahead. I say this very often, mostly on a Monday, is to know what's coming ahead. Why do we want to know what's coming ahead? Well, if we've got a very heavy week, if we've got a big data point, or if we have something coming up in the future, then what we're going to be looking at is how that might impact on the volatility today. So if we've got a big event, or if we've got a number of events coming later in the week, it's more likely to be less volatile at the beginning of the week, maybe today. And then if we've got less data this week, then you can maybe adjust your strategy. If you were expecting less impact from data today, then the volatility might be less and we could see narrower ranges in here. So Scott can't hear. Okay, he's got it now. Okay, so so we're going to go through here. You haven't really missed anything, Scott, by the way. So I'm just introducing what I'm going to be doing and looking at now. So and you can always catch it on the recording. So this is recording. It'll be in the slot you're looking at the webinar in right now. You can catch it on the recording. Okay, right. So let's go through what we've got coming up. Before we do that, I'm just going to highlight. You can get these both in the members area, in the trading room. I'm not going to go there now, because if I go there, that's where where you are, the page you're on now. I'm streaming this webinar, and there's the fundamental events, and the fundamental reports and the technical analysis reports. Under the fundamental reports over the weekend, I put these up. So we have these go up every week. We have the longer trade day macro matters. Okay. And then on the macro matters, we're going to quickly run through what we kind of covered in there. And that's kind of condensed a little bit into this weekly recap and update in here, where we also look ahead to what's coming up. So I'm going to run through those in here very briefly. And then this gives us an idea of what's coming up for the shape of the week. We'll look through the calendar, look at what's coming up for the week, and on both the macro and the earnings side, the macro data and the earnings side, central banks. And then we'll take a look at some articles currently from the major news wires. And then we'll take a very brief look, because I've got to get through all of that. And I don't want to keep you guys too long. I'll take a look at the charts, but very briefly. So, and you can always go and check out the technical analysis. Again, the technical analysis reports on the same page that you're in the members area, in the trading room. Okay, you can click on those daily technical analysis reports. So let's take a look at, I'm going to actually just run through this macro matters, so you can go and get that here. I'll put that into the chat. You can download it there. So focusing on, obviously, last week's big event was early in the week, the Fitch downgrade of the US credit rating, longer duration yields spiking higher, increase in bond market volatility. The initial move was not in bonds, it was in stocks. Then bonds played catch up, and then even weighed more in stocks. So we moved to higher yields, sold off, bond market sold off, went to lower prices, higher yields, and those higher yields impacting negatively onto stock indices. And stock indices were the first to move on Wednesday. Bonds played a little bit of catch up, as we can see in here. So this came out Tuesday night. Why is this not updating? Why is it not loading? I was just looking at it just now. Come on, refresh. Here we go. So if we look back in here, it's gone smaller again. On Tuesday when it was announced, so what day was Tuesday? Today's the 7th, so it was the 31st, it was the 1st, right? So here is when it was announced. So we did kind of pop a little bit higher in yields, but it was really the next 2 days where we really got accelerating higher. And then we reversed lower on the employment data on Friday, but then the market's pushing back higher in yields this is, okay? Higher in yields, not higher in price, going lower in price, higher in yields. So this higher yield move that we saw last week really weighed on the stock indices. But it wasn't an aggressive move higher on Monday. So that news came out Tuesday night, right? It came out Tuesday night. So this is Tuesday. And we'd already, I think, pushed higher in yield. So it wasn't a big move. It wasn't until really the Wednesday, Thursday, we really got motor and we pushed through this peak. Not only that peak there, but it was also a peak from over here. So these peaks in here at 409, 410 area, it broke through those on Wednesday, Thursday last week. And that's what really then weighed on the stock indices. Higher yields, remember, negative for stocks in here at the moment. Higher yields seen as an issue because it's reflecting concerns about recession, and it's reflecting potentially higher interest rates, longer term interest rates, and weighing more negatively on stocks, particularly on the Nasdaq. Higher yields, remember, the Nasdaq is full of growth stocks. Growth stocks are susceptible to higher yields. Why? Because it's all around the discounted cash flow. In growth stocks, we're expecting more cash flow in the future. Okay, we're looking for growth, and if we have a higher yield, a higher long-term interest rate, then that diminishes the value of those future cash flows for growth stocks. Okay, so there we go. This is an important chart to be looking at. This, and alongside, I'm going to minimize it here, but these bond charts, okay, got the 30-year bond yield. Okay, we're smashed through the previous low yields in here from back earlier this year, and then back from in here from early July, okay, mid to early July. We smashed through those last week. Obviously, we had the rebound in price, down in yield, and then going back lower in yield. That's on the 30-year. The 10-year also went through, just got through the low price. Remember, on the yield, we went through easy, right? We went through on the Wednesday, I think it was. We go back here, we went through on the Wednesday, okay, went through that high yield, okay, from the early part of July, and then also this yield over here from back in, when was this? This was back in March, okay? But if then we look at on the price chart, okay, the price chart only broke through on the 10-year through the low here, back on, it went through on Friday and then spiked back above. So it kind of breached it, okay, and then spiked back above. But we're tracking back lower in price, higher in yields. And then it's mostly at the long end, the 10s and the 10s and the 30s. If we look at fives haven't moved as much. Why? Because the fives are more susceptible to short-term interest rates, okay? And short-term interest rates are more staying fixed, okay? We're not seeing a big movement in short-term interest rates. The Fed are not going to change necessarily what they're going to do. This has all been more to do with concerns about, obviously, that Fitch downgrade for longer-term bonds, okay, plus the concerns about recessionary pressures, which are going to affect longer-term bonds. And you can see much more violent move higher in price on Friday after that non-farm payroll number, and also higher in price on the 2 years as well. So the 5-year and 2-year are moving more aggressively to higher prices, lower yields. Okay, so that's what we've seen in here last week. Right. So going back to my what we were going through. So the Fitch downgrade was important. Okay, both on macro matters we're covering in here, and then on the US 10-year, US index futures looking for support. So earnings season winding down. We've already seen that. Dovish inflation for soft ISM and non-farm payroll. So non-farm payrolls kind of in here was below expectations. Initially, the market liked that, right? So the initial move after the employment report was up for stocks, okay? Because we're basically, even though jobs growth was worse than expected, right? Worse than expected. It was 187,000. If we just go back to the daily calendar in here, and I jump back to last week. So where are we in here last week? I'm going to go from Friday through to today. So if we look at the employment report from Friday, you can see worse than expected 187 versus 200, and particularly after the ADP, remember, it was a big beat back on Wednesday. So if I jump back even further to the ADP data in here, from last Wednesday, ADP in here, big beat, 189 expected, 324. So expectations were ratcheted up for the employment report, but we didn't deliver and we were below. So 200 expected, 187 was delivered, okay, on the non-farm payroll element. On the employment report in here, it nudged lower, so slightly beat at 3.5, so slightly better in here. So basically what happened here is this was like kind of really good report for the market. What we don't want to see is too strong a payroll, yeah? Too strong a payroll opens the door to the Fed being more aggressively hawkish. But we didn't see that. We saw it slightly worse than expected, showing a slightly weakening labour market. But we want to see a slightly weakening labour market. We don't want to see too strong. The labour market, as we know, has stayed really, 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 really strong in here throughout the interest rate hikes we've seen in here over the last 1.5 years, okay, from the US Fed and also from global central banks. So we're seeing, and that strong, tight labour market, okay, is not good in that it can feed through to higher wages and then in turn higher inflation. So we don't want to see too strong a labour market. We do want to see it slightly weakened, but not too weakened, because obviously it can derail then the recovery. Okay, we don't want the stock market recovery derailed necessarily if you're a bull. Okay, and the economic recovery. And if we look here, if I zoom in to the 30-minute chart on the ES, so after the data back on Friday, the initial move, right? So let me just get this right. Where are we? Friday. So Friday, what was the date on Friday? It was the 4th, right? 4, 5, 6, 7. So where are we? 1:30. So the initial move here was to spike higher, right? It wasn't a huge spike higher, and then it was choppy through then. So this was the actual move here. It's a 30-minute chart on the ES, on the S&P, right? So that's when the data comes out, choppy but up, okay? And then here, an hour later, here, this is when the stock market opens, when the cash market opens. Again, choppy, it spikes up, spikes down, and then goes higher. So the initial move was all positive because that data was actually kind of fairly positive for stocks. But then, you know what, took over in here, boom, massive sell-off into the close in here. Why do we get the big sell-off? Because the market's just twitchy and nervous, right? Clearly, and it kind of overbought as well. If I go back to a daily, right, we've had this big push up, right? The market's been really big push up in here, all the way from back here from March, up, and then it's been a bit sideways and was almost looking overbought. Look at down here, you know, overbought on the RSI, and then no doubt looking for a reason to correct lower. And so we get this sell-off in here going into the close, okay? So sell-off into the close, boom, 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 right? Even though the data was probably bullish, okay? It was actually bullish for the market, okay? In that it wasn't too hot, not too cold, Goldilocks, just about right. Not too hot, not too cold, just about right. But then we sell off into the close because the market's twitchy and nervous because of the ongoing concerns regarding that debt ceiling, okay? So not the debt ceiling, the debt downgrade, excuse me, okay, which was on the back of the debt ceiling issues we had previously this year. Right, okay, I'm getting a little bit off track in here. Let me pull us back onto track. Okay, so going back to the macro matters, talking about that in here, but I'm going to let you run through and read this at your own leisure. We had a relatively dovish hike from the Bank of England. They did hike rates last week, and then but now indicating that maybe that might be near or getting close to the top, and the ECB pivoting maybe towards going on a pause in here. And out of Asia, we keep getting this Chinese stimulus, these rumors about Chinese stimulus, or we're getting very slow stimulus from China, which remember is in a deflationary. They're in a deflationary prices falling as opposed to inflationary falling in China. Okay, and we've been expecting, and the Chinese authority have been telling us we're going to get stimulus. We do keep getting bits of stimulus, but they're very, very slow, gradual pieces of stimulus. Still looking for a bigger stimulus out of China. So those are all things we're concentrating on there. I'm going to leave you to look through that. Kind of covered in here, but slightly more condensed version in the weekly update. So Chinese stimulus, non-farm payroll, Fitch down rating, Bank of England. Okay, corporate earnings. So in here, we're kind of going to not look at these as much anymore. Eli Lilly in here and Disney were the main two focal points this week. And then moving on to what we got. Well, we've got very little on the central bank side. We do get some Fed speakers in here. We'll highlight Harker and Bowman. We have further Fed speakers today. If I go through to today, in here to today's calendar, we get Harker, Bostic, and Bowman all speaking today. Harker, Bostic, Bowman in here in 30 minutes, 45, and both in 45 minutes. So we get 3 Fed speakers in here later today. That's going to be the main focus today. We have very, very little on the calendar. Jumping back to the update in here, the weekly update, you can see NA, nothing applicable on it, but we do have those Fed speakers. And running through the week there, so we've got that Eli Lilly and Walt Disney in here. The main two we're maybe watching out for on the earnings side. I'm not going to be really focusing on earnings on a daily basis going forward. Looking at the bigger data through the week, Chinese trade balance and US trade balance, or US trade balance is a real non-piece of data. Chinese trade balance, the critical data of the week, highlighted here is that's a typo in there. US PPI. Look, US CPI, that should be here. Oh no, that is US PPI. That's correct. Sorry. US CPI dominates the data for the week on Thursday. This is the critical. This is the most important. This is arguably more important than the employment data. So all focus is going to be back on that later in the week. It could mean that we've got a relatively quiet start to the week, Monday, Tuesday. It's probably the biggest piece of data, more important. Generally speaking, over the 30 plus years I've been in financial markets, all eyes are, have regularly been on the employment report that comes at the beginning of the month. Now we're looking at the CPI data, which hasn't been as big a focus over my career, but given that we're in the very inflationary world that we are in for the last couple of years, then the CPI, the inflation report, is the most watched piece of data, and probably the most important piece of data we watch. So we're keeping an eye out for that. It doesn't come till Thursday, so markets could be relatively quiet at the first half of the week compared to what we've seen more recently, maybe more in a consolidation kind of mode as we go through this week. Right, I'm feeling like I'm off track a little bit again in here. We have had some data this morning, so there's not much coming up. Harker, Bostic, and Bowman speaking over the next 45 minutes. One in Bostic and Harker in 30 minutes, and both Bostic and Bowman in just under 45 minutes time now. And we did get this German data. Industrial output falls further in June, and you can see this industrial data worse than expected. In red in here, missing expectations, the German industrial production data. What else? Let's just run through some stuff in here. 5 things to start your day. Remember, you can sign up to this if you haven't already. Go to the Bloomberg homepage. Okay, no payment on this. This is a freebie. They don't give you much for free. Go over here on the right-hand side of the markets page in here, Bloomberg Markets. Bloomberg.com/markets. Sign up over here and you'll get this in your inbox. Whichever time zone you're in, they do 3 of these a day for Asia, Europe, and the US. And this is going to be the US one we're looking at right now. And you'll get it dropped into your inbox each morning. And you can also look at it online. So let's take a look at 5 things to start your day. Further rate hikes may be needed by the Fed to get inflation to its target, according to Governor Michelle Bowman. So Bowman said that there's data released since the Fed. So in here, 2 other Fed officials, Raphael Bostic and Goolsbee, both said jobs data last week indicate the labour market is getting into a better balance. Okay, so we have had some speakers already. Just opening this one out in here from Bowman in here. Governor seeks consistent ever so slower prices. So, but then remember to go and take a look at. Remember again, if I go to tradeday.com in here, remember the resource. This is one worth bookmarking, guys, right? Under the trading advice at tradeday.com. This is also in the, but if I go in here, I think it's going to be on the next page. Where are we? So where is it in here? Where are we? Let's just go to all. There's a lot in all, though. That's the only trouble. And then we go down and we want the Hawk Dove sheet. So there's a lot of stuff in here. Oh, there. Oh, no, it's not there. Maybe all is not the best place to go for this. Trade day vols, macro matters. Oh, I can't find it. I'll find it in a second, guys. I've got it bookmarked, I think, anyway, myself. Let me just see if I can find it here before I go look for the book. Here it is. FOMC Hawk and Dove sheet. Okay, I'm going to put this in the chat. This is one worth bookmarking for you guys. Just conscious of time in here. So in here, Hawk Dove sheet. Remember, this is the members of the FOMC and whether they're more dovish or more hawkish. And we can see in here, we're talking about where are we in here? Bowman, okay, and where's Bowman on the scale? Down here is a hawk, okay, towards the hawkish end, okay. So no surprising in here, a hawk saying something relatively hawkish, okay, Michelle Bowman, okay. So no real surprises there that we get a hawk saying something relatively hawkish, saying that we may have to go higher. What's important is when we see a hawk saying something slightly more dovish or a dove saying something more hawkish. Right, let's carry on. The latest Market Live Pulse survey paints a gloomy picture. Majority of it's the US recession before 2024 is over, okay? Looking out into next year, okay? So we've had real mix, whether we're going to get a soft landing, a hard landing. At the moment, US avoiding recession. Are we going to get that in here? Berkshire Hathaway, not really significant to us. Yields rising again. We've already looked at that in here, and quiet on the data front. As we said, Bostic and Bowman speaking. What else do I have for you? So Bowman we've already spoken about. So treasuries are going back down, lower in price, higher in yields, but stocks have slightly rebounded in here. Wheat prices have jumped. We had this drone attack because of concerns around shipping routes. Okay, so that's pushed wheat prices up. That is an inflationary spectre on the horizon. Also potentially going to push oil prices up as well. We're going to look at that shortly in here. What else do I have in here? That's not, I don't need that one in here. Let me load this. So Wall Street set for rebound after worst week since March. So it was a very negative week last week, because of that downgrade, because of the spike in higher yields. And although we looked to get a rebound, it looked like we were rebounding at the end of last week, and that just on Friday after the employment report, and it turned around to a very weak end to the week. And futures rise following turbulent week. US inflation in focus. We've already spoken about that coming up on Thursday, and oil edges lower, okay, with stronger dollar, okay. So oil edges lower, despite in here, sea drone hits Russian Navy vessel and tanker in recent days. So this should be obviously less supply pushing up oil prices. However, the fact that we've got a stronger dollar, remember, commodities moving in the opposite, commodities that are priced in dollars. If the dollar weakens, commodities tend to go up. And if the dollar strengthens, as it has done in here, then then commodities tend to push back lower. I'm going to park the Fed Watch tool in here for today. There's not a lot going on this in here at the moment, so I'm just going to leave that for today. And just running through where we are on the overnights. Asian stock market's fairly flat this morning, okay, on the overnight. So Nikkei was up less than 0.2. The Hang Seng was pretty much unchanged. In Europe in here so far today, we have had a dip lower, but these are playing catch up, remember, to the fact that we saw the sell-off in stock indices in the US after hours, okay. So these are down because this didn't fully pick up. The European indices didn't get that later session sell-off in here. They were already closed by the time that the US was selling off in here. So that's why they were pulled down. They're kind of playing catch up on the downside. These are the cash markets, okay, in the in Europe. And if we look, we obviously were lower back on Friday by about 0.5% on the Dow and the S&P 500. And if we load though in here now, you can see we've made up some of those losses that we suffered back on Friday. Dow's up less than 0.2, the S&P nearly 0.3, and the Nasdaq up 0.4. A very, very quick nod to the charts, and it will be quick in here. But for me, if we go and take a look at the dailies in here, they still remain vulnerable despite us rebounding from the lows in here. This was a really significant correction. If you go and look at the technical analysis, we shifted about 2-3 days ago, like Wednesday, I think we shifted. Wednesday through Thursday is shifting more negative with this sell-off in here. We broke through this 13-period EMA, this exponential moving average, which has been providing support, significantly below there. And then you see, look, we spiked up to that 13-period EMA back on Friday and fell down from it. And despite the bounce in here, I would class this as a dead cat bounce. What's a dead cat bounce? Well, dead cats don't bounce. So a dead cat bounce in here from Friday's sell-off. And it all looks very vulnerable. This is the ES. We go to the 30-minute chart in here. There's Friday's late. There's the move higher we've already looked at. Okay, there's the move higher back from Friday after the data. There's the sell-off into the latter part of the session, into the late session. Okay, there's the overnight rebound, and that rebound fading already. So if I just get rid of all these drawing tools in here, so you've got these kind of counter trend lines. Market's been trying to break above these counter trend lines, but on that higher one, really not managing it here on the higher one. So kind of fading on this higher trend line and fading back lower. And if we look on the bigger chart, there's definitely topping pattern up there on the 30 minutes. Like it's almost like a head and shoulders top up here, and looks like we can go further and fading now. And if I just put the little uptrend, or you can see we're already down through that little recovery uptrend from overnight. You have it up through here somewhere, right? We're already up down through that, so looking vulnerable. And what have we given back up? If we go and put the Fibonacci retracement in here, okay, you can see we're down through halfway. So Friday, the overnight rebound, we're giving half of that back nearly. We just defended the 61.8% retracement of the overnight rebound. That's like at 45.04.5, down through there, down through 45.04.5, looks more vulnerable, and certainly looking vulnerable now. Nasdaq's a similar story. Again, look, it was flirting with the 13-period EMA on the daily chart. You've almost got like a double top pattern when we broke through this low back last Wednesday. A failure now using the 13-period EMA as resistance back on Friday. Again, a dead cat bounce. On Friday, we almost went back to Thursday's low. Dead cat bouncing here, seeing that on the 30-minute chart now. So we have reversed through these trend lines in here, these previous trend lines, but the market now looking particularly vulnerable, I think, to further losses. Just get rid of these trend lines in here. And you can see on the overnight again, we're down through. There's the big sell-off on the close on Friday. Got right down to the previous low, just rebounding and fading in here. And if we go and take a look at what's happened on the rebound in here, so first of all, where we come off of a resistance, there's Friday's sell-off, right? There's Friday's sell-off. Okay, so we faded, look below the 50%. Okay, and then what have we given back? Okay, in here on the retracement levels. Okay, again, look through the 50 and we're holding above the 61.8. So I think back down through the overnight low, back down through on the 15,400 basically, and then 15,394. Back down through there looks really vulnerable, and then reinforce through this 61.8, 15,386. So those would then send us to the low and potentially lower. Not looking for a big move in here today. As I say, we've got very little on we've got obviously those Fed speakers in about the next 30 minutes, but other than that, there's not a huge amount to focus on there's nothing to focus on the data side. So I think the market is more likely to be more of a consolidation day, but for me, still consolidating maybe a little lower before we get any kind of rebound going. If it takes out the overnight highs, both here on the Nasdaq, so back up through 15,466.5 on the Nasdaq, or and then it's got to be the overnight high in here on the S&P is 45.22. Through those opens up upside. So go short on dead cats. Yeah, basically, a dead cat is basically saying, the market should have, after yesterday Friday's sell-off, it's tried to rebound, hasn't done enough, hasn't really got any resistance back. A dead cat bounce is basically market hasn't bounced, looks vulnerable still, tried to bounce, didn't even get back to initial resistance points. It's a low level bounce, considering how negative we were both on Friday and all of last week. Even though we got, they love a headline, right? So even though we see headlines like, Treasury side, this US futures signal rebound. Well, they're signaling a rebound, but it's hardly a rebound. It's a dead cat rebound. But they like a headline, right? That's what they're paid to do, to write some headlines and try and get it going. But unfortunately, you look at the chart, and the chart tells you a different story. That it's not much of a rebound at all. All right, guys, I've got a 1 o'clock. So for me, it's 1 o'clock. For you guys, depending on where you are, it's 5, 6, maybe 7 hours the other side of that, before that. But I've got a call in just under 1 minute. So I'm going to wrap it up there. Any questions, please? Well, actually, I can't take any questions. I should have put them in already. I'm going to wish you all a great trading day. Take care. Take care. Stay safe. I'll be back to you with another bull versus bear webinar tomorrow. Have a good one, guys. Bye.